Hi everyone, Ramos Gabriel from IT Wealth Management here. This is the last video in our insurance series, Estate Preservation. In this video, we will discuss the role that insurance plays in estate preservation and creation, and I will take you through a case study that illustrates some of the concepts. So let's begin. Estate goals involve estate preservation or estate creation or both. Regardless of which one of these is your goal, the strategic use of life insurance can help achieve that objective. Let's start with estate preservation. Taxes, legal, and probate expenses are the most common expenses that may erode the value of your estate. First, with regards to taxes, an RRSP or a RIF will roll over tax deferred to the spouse. However, upon death of the spouse, a deemed disposition will be applied. The beneficiaries will inherit the RRSP or RIF, but will have to pay the taxes on it immediately. The tax treatment of an RRSP or a RIF is identical to that of employment income. So receiving a large amount at once may trigger a tax liability at the highest bracket. Consider also a capital property that is not the principal residence, for example, a cottage or a rental property. Upon death, a deemed disposition will apply, and the tax liability on half of the capital gain of the property will have to be paid by the beneficiaries. In these cases, the beneficiaries often have to sell the property in order to cover the tax liability. This is particularly difficult in cases where the property is a family heirloom. For example, for some people, a cottage has been in the family for several generations, and they would like to keep it in the family. The next is legal, probate, and other estate costs. These costs are associated with the administration of an estate, and they can significantly erode an estate's value. A permanent second-to-die life insurance policy can be the solution to these problems. Life insurance proceeds can be used to help pay for funeral expenses, debts, legal fees, tax liabilities, and probate fees, thereby preserving as much of the estate as possible for the beneficiaries. Now let's say you don't have any significant assets to leave behind, or you want to grow your financial legacy to your beneficiaries. You can create an estate using life insurance. There are life insurance policies that can serve as investment vehicles. Permanent participating life insurance or universal life insurance can serve as investment vehicles where the tax is deferred until death of the owner. There are certain conditions with regards to universal life in particular that have to be met in order for the tax to be deferred, but that's outside the scope of this presentation. Another way to use life insurance for estate creation involves estate equalization. Let's say one of your children is interested in an asset while the other is not. This could be a number of things, usually a family cottage or a family business. Let's use the family business as an example. One child is involved in the family business and will inherit it, while the other has a completely different career and is not interested in the business. An amount equivalent to the family business can be given to the other child in the form of proceeds from life insurance. This would ensure that both children will receive a financial legacy of the same value. There's also a situation where someone wants to leave a financial gift for a charity. A financial gift can be provided to a charity in the form of proceeds from a life insurance. The donation can come out of the estate via a will, or the charity can be made the beneficiary on the death benefit. There are advantages to the latter option that I won't discuss now for the sake of time. Now let's go through a case study to illustrate what we've just covered. Consider this fictitious couple, Sally and Joe, ages 51 and 49 respectively. Assume a life expectancy of 85 for Sally and 83 for Joe. So in 34 years, their beneficiaries will receive an inheritance. They have three major assets: a cottage, RRSP or RIF, and company shares. Their assets today total $1.45 million. The future value of their assets in 34 years upon death will be around $15 million, with an expected tax liability of $3.7 million. The value that their assets will be in 34 years from now is called a future value. Future value involves the concept of time value of money. $1 today is worth less than $1 10 years ago, and it's worth more than $1 in 10 years from today. Now let's consider three options to fund the tax liability to best preserve their estate. Recall the concept of time value of money. The present value is the equivalent, in today's dollars, of the $3.7 million that we will need to pay in 34 years. So the lower the present value today, the better, since we want the cost to fund the future tax liability to be as low as possible. Let's assume that the present value discount rate is 4%. Now looking at the options, the first option, option A, is savings. If we save just under $116,000 annually over 10 years, the present value of these savings would be $976,000. This amount, projected 34 years into the future, would give us the $3.7 million tax liability needed. The second option, option B, is a lump sum payment of $976,000. Just like option A, this would grow to $3.7 million in 34 years. But providing a lump sum of that amount, earmarked for the tax liability, is not feasible for most people. The third option, option C, is taking out a second to die permanent life insurance policy today with an initial face value of $1.65 million. Since this policy would be participating or universal life, it will have an invested cash value that will bring the death benefit to $3.7 million in 34 years. The estimated premium is $88,000 per year, paid up in 10 years. This means that you pay for the policy over 10 years and then there are no further premiums to be paid. You've paid it up. The present value of the premiums paid on this policy is about $743,000. This is by far the cheapest option of the three. Of course, we're assuming that this policy is an estimate based on a standard rating. Now to summarize, the present value of the cost of funding the tax liability is $976,000 for savings, the same amount for a lump sum payment, and $743,000 for life insurance. So that concludes the insurance series. Thanks for watching, and if you have any questions, don't hesitate to reach out.